Hey everyone, welcome back to the Web3 Daily. The vibe in the crypto space today, it's a little hard to pin down. You've got Bitcoin in a tug of war at a key level. It feels like it's hit a wall, but at the same time, it refuses to drop. It's just grinding everyone's patience. And it's probably got a lot of you wondering, is this the market coiling up for a massive breakout? Or is this the quiet before a serious downturn? But you know, when you dig into the data, things get pretty interesting. While Bitcoin's price is just treading water, those spot Bitcoin ETFs over in the States have been on a buying spree for several days straight, with hundreds of millions of dollars quietly flowing in. This tells you Wall Street's big money is still steadily entering the game. And another thing, have you noticed how Ethereum seems to have a bit more juice than Bitcoin lately? That ETH to BTC chart has been quietly creeping up. I get the feeling the market's hot money is getting restless and starting to peek at some altcoins. It seems like the market's risk appetite is slowly on the rise. And speaking of Wall Street, the hottest topic lighting up the crypto space today is a real blockbuster. The Winklevoss twins exchange, Gemini, is finally about to ring the bell on the Nasdaq. When I first saw the news, my immediate thought was, so the show is finally starting. Gemini priced its IPO at 28 a share, giving it a valuation of around 3.3 billion. And I'm hearing the market's reaction was absolutely insane. It was oversubscribed by a whopping 20 times. What does that tell you? It tells you that traditional capital is absolutely starving for regulated crypto assets. But here's a twist. If you actually look at Gemini's financials, you'll find they lost several $100 million last year. So on one hand, you have these massive losses. But on the other, the IPO was a feeding frenzy. It's a bit of a head-scratcher, right? What exactly is Wall Street thinking? Honestly, I don't think they're investing in Gemini's current ability to turn a profit. They're making a bet on a single word, compliance. In a world where the regulatory hammer could drop at any moment, the exchange that's already fully licensed and playing by the rules is the one best positioned to capture the coming wave of institutional money. Gemini has been the teacher's pet from the start, collecting more licenses in the US than pretty much anyone. That regulatory moat, which they built with a ton of time and money, is their real crown jewel. And get this, Nasdaq itself made a strategic investment in the IPO. The message is loud and clear. The old guard of traditional finance isn't just getting comfortable with crypto. They're actively pulling it into their world. Gemini going public? This is probably just the opening act. And Gemini's successful IPO? Well, that couldn't have happened without the subtle but significant shifts we're seeing in the US regulatory landscape. In fact, some news just dropped from the SEC that has the entire industry buzzing. At a high-level conference, SEC Chair Paul Atkins unveiled a new blueprint he's calling Project Crypto. Honestly, when I saw this, I had to read it twice. He kicked things off by openly slamming the old approach of regulation by enforcement. To put it bluntly, he's saying, the era of setting rules through endless lawsuits is over. They want to give the market a clear, unified playbook. Can you believe that? This could mean the SEC is trying to pivot from being the industry's public enemy, number one, to a regulator you can actually have a conversation with. This plan has a few core pillars that I think are absolutely critical. First, they want to create a clear classification system for crypto assets, telling everyone what's a security and what's a commodity, so projects can stop walking on eggshells. Second, they talked about supporting the growth of super apps. Think of wallets that bundle trading, payments, and social features. The idea is that regulation should make room for these things to innovate, not crush them. And finally, a really important point, they want to modernize the ancient custody rules, acknowledging that holding crypto is a completely different ballgame than holding stocks. For the future of Web3 in the United States, this is a seismic shift, and the reaction was immediate. You had heavy hitters from firms like Bernstein and Bitwise applauding the move, calling it the constructive, common sense change they've been waiting for. But you know how it is in crypto. It's always a mix of good news and bad. Just as we get some fantastic news on the regulatory front, the security alarms start going off. And something just happened that I think everyone in Web3, especially developers, needs to pay serious attention to. This wasn't a hack on a specific DeFi protocol. This time, the problem came from the source code itself. Hackers targeted the code libraries that developers rely on every single day, specifically the NPM packages for JavaScript. Their method was classic, really. They just blasted out phishing emails and managed to steal the account credentials for the maintainers of at least 18 popular code libraries. And these libraries, they're like the Lego bricks of the internet. Countless projects use them to build their applications and websites. Once the hackers were in, they silently slipped their malicious code into the official software packages. If a project then used one of these poisoned Lego bricks, the code would lie in wait. The moment an end user with a crypto wallet like MetaMask or Exodus interacted with the site, the code would activate and start draining their funds. So what's the really scary part? It's the sheer scale of the potential damage. As a regular user, you could be browsing a totally legitimate looking website or using your favorite dApp, and you'd have absolutely no idea that the code underneath is compromised. It's an attack vector that's incredibly difficult to guard against. So this is a huge wake-up call for everyone. Security in our space is a systemic issue. The market carries risk, and hackers are absolutely everywhere. So we just talked about the US, possibly loosening its regulatory grip. But on the other side of the globe, in Asia's one-time crypto hub, Singapore, the message is the complete opposite. They are tightening the screws, and they are tightening them hard. The Monetary Authority of Singapore, the MAS, just officially announced that any crypto company based in Singapore that serves only overseas clients now has to get a full local license to operate. You might be thinking, well, duh, of course they should. But it's not that simple. For years, these firms existed in a regulatory gray zone. Since their customers weren't Singaporean, the rules were much more relaxed. Well, that loophole has now been slammed shut. But here's the real kicker. The standards for getting that license have been raised so high, they're practically impossible to meet. I'm hearing from insiders that the MAS has pretty much put a freeze on issuing any new licenses. The message is, if you don't already have one, you're probably not going to get one. So why the sudden 180 from Singapore? It's actually not that surprising if you look at their recent history. Think about the Terra Luna collapse and the Three Arrows capital disaster. Both of those implosions had deep roots in Singapore, and it was a huge black eye for their reputation as a top-tier financial hub. What they're doing now is basically a massive exercise in risk management. They're saying they refuse to be the scapegoat for crypto companies that blow up offshore. They are willing to sacrifice some of their Web3 growth to protect their hard-earned reputation as a stable financial hub. Alright, we've covered the macro regulatory picture, so let's zoom back in on the technology itself. Because no matter what's happening in the outside world, the devs on Ethereum, well, they never stop building. And just recently, the Ethereum Foundation quietly dropped a major bombshell. They published a long-term roadmap for what they're calling end-to-end privacy on Ethereum. The simple version, the goal is to eventually make using Ethereum feel as private as a secret chat on Signal or Telegram, where the entire process is shielded. Have you ever stopped to think about it? The Ethereum we use today is basically a giant, transparent glass ledger. Every single transaction, every token in your wallet, it's all public for the world to see. For regular users, that's a massive privacy concern. But for the big institutions, it's a deal breaker. I mean, what trading firm wants its competitors to see its entire playbook? So this new roadmap from the ETH is designed to tackle that head-on. Through a series of upgrades like private writes and private reads, they plan to slowly transform this glass ledger into a privacy-preserving system. I honestly think this is a bigger deal than almost any past upgrade or fork Ethereum has gone through. Why? Because it attacks one of the biggest roadblocks to mass adoption. Only when privacy is guaranteed can those trillion-dollar financial institutions feel safe enough to bring their core operations on-chain. This roadmap might take years to come to fruition, but it paints a powerful vision for the market. Ethereum's grand vision for privacy is incredible. But let's be real, that's years away. So what's hot right now? Without a doubt, is the absolute dogfight between all the Layer 2 networks. And just recently, a new L2 has come out of nowhere and caught fire, all because of a meme coin. The network is XLayer, the L2 from the OKX exchange. In just the last 24 hours, its on-chain trading volume went absolutely parabolic, rocketing to $77 million. That's a quarterly increase of over 110%. I mean, I had to do a double take when I saw that number. So what's fueling this rocket ship? You'll probably already know the answer. It's a meme coin. A token called XDog has been ripping on XLayer. Its market cap hitting $120 million after a 30% pump in 24 hours. And a massive chunk of the network's volume is just the people trading this one coin. But if you zoom out, you start to see a pattern here, right? This has become the go-to playbook for launching a new L2. We saw it with Base, and now we're seeing it with XLayer. The fastest, most brute force way to bootstrap an ecosystem is to get a meme coin to go nuclear. You use the hype to pull in a ton of users and liquidity, and then you try to build out a real DeFi ecosystem on the back of it. This meme-driven growth strategy is super effective in the short term, but it's also a double-edged sword. Meme coin hype can vanish as quickly as it appears. The big question is, once the frenzy fades, can any of that volume and activity be retained as actual long-term value for the network? That's the billion-dollar question. So while we just saw Singapore basically shutting its doors to new crypto businesses, another massive country in Asia, Pakistan, is making a move in the complete opposite direction. It looks like they're getting ready to open a window. Pakistan's financial regulators have just put out a public invitation to crypto companies worldwide, welcoming them to come to the country, apply for a license, and operate above board. I have to say, this news really caught me off guard. As most of you probably know, Pakistan's stance on crypto has been shaky at best, and often outright hostile. Their own central bank was trying to get the whole industry banned not too long ago. So for them to do a complete 180 and roll out the welcome mat, the motivation here is pretty fascinating. For starters, Pakistan has one of the largest crypto user bases in the world. A huge chunk of their young population is already active in the market. Rather than letting all that economic activity happen in the shadows, it makes a lot more sense to bring it into the light, regulate it, and, of course, tax it. Plus, for a developing nation like Pakistan, crypto represents a powerful channel to attract foreign investment and make remittances easier. So if you take a step back, you can see this fascinating divergence in global regulation. You've got the established financial hubs like Singapore, who are now wealthy enough to be selective. And then you have emerging markets like Pakistan, who are hungry to capture the growth that this Web3 wave can bring. A global competition for the future of crypto regulation is heating up, and it's happening right before our eyes. Alright, that's all for today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. Every day, we sift through the noise to bring you the most critical insights in the Web3 world, the information that's closest to the money. We hope that by breaking down these hand-picked stories, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped some exclusive registration links for major exchanges in the comments section below. These are special high rebate deals we've arranged for our community, hopefully saving you some cost as you invest. Let's all stay rational, move steadily, and get rich slowly together in the world of Web3. May everyone's crypto portfolio see steady growth. I'll see you all tomorrow.